Today we're going to have some fun with depreciation. Over on this side I've kind of listed how it will be given to you in one of the homework problems. This example, it says new lithographic equipment acquired at the cost of $800,000 on March 1st of year 1, which was the beginning of the year, has an estimated useful life of 5 years and an estimated residual value of $90,000. The manager requested information regarding the effect of alternative methods on the amount of depreciation expense each year. And then we're told on March 4th of year 5 the equipment is sold for $135,000. We're supposed to do a few things. One, we're going to calculate the depreciation under the straight line method. We're going to calculate it under the double declining balance method. And then we're going to journalize the entry to record the sale, assuming we had chosen the double declining balance method. And then we're going to do the entry for the sale, assuming a different sales price. Okay, so over here I have picked out the details that matter to us for calculating the depreciation. Our cost is $800,000. The scrap or residual value is $90,000. And I've just put some notes up here. The depreciable cost equals cost minus the scrap value. So in total we want to be able to depreciate here $710,000. That'd be the $80,000 minus $90,000, and we're going to do that over 5 years. It's also important to notice that even though this is March 1st, we're not dealing with a partial year in year 1 because March 1st is the beginning of the fiscal year. They don't have a calendar year end. They have a year end that's ending then on February 28th. And it starts again on March 1st. Okay, so let's come over here and do straight line. It is the easiest. Okay, so depreciation expense, I put a little note up here to remind you depreciable cost divided by life gives you depreciation expense for any given year. So let me go ahead and just type it out. This equals the depreciable cost. I already said that was the $800,000. Minus the scrap. Okay, that amount, which should be, $710,000, divided by 5 years, because it has a 5-year life. That's it. Depreciation expense for year 1 is done. And guess what? Depreciation expense under the straight line method is going to be exactly the same every single year. Okay, unless it's a partial year, it's always going to be the same. Straight line is certainly the easiest. Now, to get our accumulated depreciation, EOY here is for end of the year. Okay, I want my end of the year accumulated depreciation. You're always going to add the prior year accumulated depreciation plus the current year depreciation expense. Well, in year 1 there was no prior year depreciation, so it's just 0 plus the depreciation expense. Okay, so at the end of the first year, the accumulated depreciation is $142,000. It's going to be the same as depreciation expense in year 1. Okay, now the book value at the end of the year, cost minus the accumulated depreciation, is the book value. So here we can say this equals the $800,000 minus this accumulated depreciation right here. Okay, so book value at the end of year 1 is $658,000. So let's quickly finish out this little table here. We said that you always take the beginning amount. So now we're starting out with 142 and we're adding to it the other 142 from this year. So our accumulated depreciation for year 2 is 284. Okay, and we're going to do the same thing here. This is going to be the cost minus this number right here. Okay, so now our book value is $516,000. We're going to just continue doing the same. This right here equals the prior year amount plus the current year amount. Book value then equals the original cost minus current year, at the end of the year, accumulated depreciation. Okay, let's finish it up. This equals the prior year accumulated depreciation plus the current year depreciation expense. The end of the year book value equals the original cost minus the end of the year accumulated depreciation. One more year to finish out. This is going to equal the previous year's amount plus the current year's depreciation. Okay, and this is going to equal the cost minus the accumulated depreciation. Okay, so a couple things to notice here. When we are done fully depreciating this, the ending book value is going to be the same as scrap. Okay, we don't ever want to go below scrap value. So those are the same. The other thing you'll notice, we said that at the depreciable cost, let me go ahead and just type this out so you can see it. The depreciable cost in this case was the $800,000, and it is minus the scrap value. Okay, equals $710,000. Okay, and you can see that right here. So our accumulated depreciation, we have truly depreciated the entire depreciable cost of $710,000, and we are left with the $90,000 in scrap value. Okay, so we've got that one done. Let's move to the double declining balance method. It's handled differently. It's slightly more challenging than the straight line method, but I know you can do this. Okay, depreciation expense is always going to be whatever the beginning of the year net book value is times double the straight line rate. Okay, so when you first get this, the book value, remember net book value, let's write this down here. Net book value equals your cost, let's use minus your accumulated depreciation. Okay, and in year one, since there was no accumulated depreciation going into it, your net book value is the same as your cost. Okay, so we know what net book value is going to be for our calculation in year one. Let's talk about what this double the straight line rate means. This is a 5-year asset. We did the straight line method without even talking about the straight line rate because it's really not necessary, okay? But we can apply a rate. Basically what we're saying here is we're taking 1/5 every year. If you just change 1/5 into a percent, you get 20%. Okay, so that is the straight line rate in this case. Let me put straight line rate. Okay. Now, we're going to double that. So what is double the straight line rate? We're going to use a 40% rate. Okay, we'll have a 40% double declining balance rate. So now we have the information we need. Look up here again. Beginning of the year net book value, we said for year one, that is going to be the $800,000. And we're going to multiply that amount times our 40%. I'm just going to put 0.4. Depreciation expense is $320,000. Okay. Now, it doesn't matter what method you're using. Your accumulated depreciation is always going to be the prior year's amount plus the current year. This year, prior year amount, there wasn't any. So it's basically zero, plus this amount right here. So in year one, your end of the year accumulated depreciation is the same as your depreciation expense. Now, let's get our book value here. Okay, we said that's cost minus accumulated depreciation. I typed that in down here. I've got it right up here. So the cost is $800,000, and we're going to subtract $320,000. So our book value is now $480,000. Now, when we go to year two, remember we said depreciation expense is going to be calculated as our beginning of the year net book value times double the straight line rate. Okay, whatever the end of the year book value is for year one is the beginning of the year net book value for year two. So this is going to equal to $480,000. Okay, times our 40% rate again. Okay, so now it's $192,000 for year two. Accumulated amount, we take that from prior year, we add the current year amount to it. We now have accumulated depreciation at the end of year two of $512,000. To get the book value, we're going to take the $800,000 and we're going to subtract that, and we have a book value of $288,000 at the end of year two. And of course, this book value at the end of the year is the beginning of the year amount for the third year. So now we can say this is $288,000 times 0.4 and get the third year. Okay, I'm going to keep going with it. We're going to add these together. The prior year amount plus the current year depreciation gives us end of the year accumulated depreciation. Book value again, the original cost minus the accumulated depreciation. Our book value is now $172.8. Year 4, take our net book value at the beginning of the year, which is $172.8, multiply it times the double rate that we're using, 0.4. Oh, I did something wrong there. Hold on here, what did I do? Extra 0. That'll do it. Okay, that's better. Okay, so that's our depreciation expense. Now we're going to update our accumulated depreciation, that amount, plus the current year depreciation expense. Okay, now end of the year book value, we have the $800,000 minus the accumulated amount. Now we have book value at the end of that year. Now, year 5 is going to be done differently. Whatever your last year is, you're going to force your depreciation to be whatever it takes to make your ending book value equal scrap value. Okay, so what do I mean? We want ending book value to be $90,000 because that is our scrap value. Okay, so we know that answer. How do I get to $90,000? I have $103,680 right now in book value. I subtract the 90 that I want to end with. Okay, my depreciation expense needs to be this amount. And watch this. Okay, so we're going to take the prior year amount. We're going to add the current year amount. What did I do? Sorry. Okay, now we're going to take the prior year amount. We're going to add the current year amount. Okay, and look what happened. Our accumulated depreciation is now $710,000. Remember, that is our depreciable cost. And we have left this at $90,000. Okay, so the last year, remember, you drop in what you want your book value to be, which is scrap, and you just force it. This right here is a plug number to make all the rest of this true. Okay, so now we've finished all the depreciation calculations. Let's come up here and do our journal entries. It says on March 4th of year 5, the equipment was sold. Okay, so what they're saying is at the beginning of this year, the equipment is sold. So we're going to move work off of numbers that are actually from year 4 because year 5 is not happening yet. So let's give it a date. Let's say this is what, March 4th, so let's put a date. That didn't work out so well. There we go. Okay. We need to remove the equipment from our books. That means we're going to have to remove the equipment account itself. We need to remove its accumulated depreciation. We need to recognize the cash that we're getting, and the difference is going to be a gain or a loss. But before we start dropping those amounts in, let's just go ahead and theoretically talk about what we know that gain or loss is going to be anyway. Okay. First, let's consider what is our carrying value of this asset. We are carrying this asset at the end of year 4 at $103,680. Okay. We are going to sell it for $135,000. So we're going to sell it for more than we're carrying it at. We know we have to have a gain. So let's look at that gain. We're going to have $135,000 minus this $103,680. We should have a gain of $31,320. Okay. Let me copy that down here and turn this into text so you can continue to see how it calculated it. There we go. Okay, that's going to be our gain. Let's drop in our entry and then we're going to come back to that number. Let's recognize the cash. Okay, that's the $135,000. Now, we said we have to remove accumulated depreciation. It has a normal credit balance, so how do we zero it out? We're going to debit accumulated depreciation. Okay, let me make this a little wider here as well. Okay, we're going to debit accumulated depreciation. Remember, this is the beginning of year 5, so we have to get these numbers from the end of year 4. We want our accumulated depreciation to be this $696,320 number. Okay, now I'm going to skip a row here. Let's go ahead and take off the equipment. Its value is $800,000. Okay, now I already said we know we have a gain. So a gain is going to be a credit. We can drop that in. Now let's prove that our entry is in balance. And you can see that it is. Okay. Now, if we did not understand for some reason, theoretically, what our gain amount was, you know, we could just force this number. We know that all of our equations have to be in balance. So if our debits equal $831,320 and our credits are $800,000, we know we have to have the difference between those numbers to make it balance again. Okay. So but hopefully you understand theoretically why you have a gain or a loss, but you should also understand theoretically that you have to make this entry balance. Both of those should work together and you should end up with that same number. Okay, let's move on to selling it under this other scenario here. It says now we're going to assume that our sales price is $88,750 instead of $135,000. Now, remember what we're carrying this at. Our book value at the end of the year is $103,680. We just sold it for $88,750, so now we have a loss. Let's look at the amount of the loss. We have $88,750 minus $103,680. We're going to have a loss of $14,930. Okay, get this here for you. Let's drop in the parts we know. We have on 3.5, we now have cash, and the cash is now $88,750. Our accumulated depreciation is the same. Okay, $696,320. Let's skip a line, and let's take our equipment off with a credit. Okay. Now, this loss is going to be a debit. And we'll put it in here, 14930. Okay, now let's prove the equality of our equation. Our debits are $800,000. There's only one credit. It's $800,000. So that works. And if you did not actually understand how to get the loss, you could simply figure out what is the difference between my two sides here. 800,000 minus the 785,070, you would indeed have to come up with that. Let's just punch this in here. You've got 800,000 minus, oh, I'm probably going to get a circular error right here. Yeah, that's not work so well. Okay, but anyway, if you could come somewhere else. Let's say you have 800,000, one more zero, minus 785,070. And you can see again, we would have to have a debit of $14,930 to make this balance. Okay, so hopefully that helped. If you have any questions at all, feel free to holler at me. I'd be glad to help you.